right, a bit of March Madness at the New York Stock Exchange as some mascots for teams like Tennessee, Michigan State, Northwestern, Florida Atlantic ringing the closing bell. There it is. And take a look at where the numbers landed. It was a roller coaster day. I mean, truly madness here. Trying to keep up with the Federal Reserve. The Dow Jones fell when all was said and done by about 400 points.
Yeah, the Nasdaq and S&P also ended the day in negative territory. Both fell around 1.5 percentage points. Joining us now is CBS News reporter Sarah Ewall-Wice. Also with us is the host of financial news website TheStreet, JD Durkin. And there on Wall Street, JD, I want to start with you. You know, when you're looking at the big board and you're looking at the times when we got news from the Fed, you see it all reflected. Talk us through the highs and the lows and how the Federal Reserve and comments from Chairman Powell affected what we see there.
Well, if you're like me or any of the other market observers here on the floor today, you might feel like you need a neck brace from all the whiplash just watching investors go in the green, back to the red, back to the green, back down to the red. But ultimately, as I suspected, we saw a bit of accelerated selling into the close. Taking a look at the numbers here, all 11 sectors of the S&P 500 closing down in the red. All 30 components of the Dow 30 ending down in the red as well. And arguably, I would say from Chairman Powell's press conference, there's something for both the bulls and the bears. But without a doubt here, the bears are winning the day. To me, the ultimate driving factor was the fact that Chairman Jay Powell said our base case is for no interest rate cuts in 2023. That, to me, is really the top takeaway from the information we got today. And I argue that because coming into today's session, we follow a measure called the CME Group's FedWatch tool. And there was a lot of bets, a lot of hope and optimism, perhaps, that the Fed would maybe increase interest rates today. But ultimately, as you push later into 2023, people said they'll start to cut those rates. We found out today that's not the case. Powell making it clear if we do cut rates, it would likely be in the second half of 2024. Certainly not the type of sentiment from the chairman of the Federal Reserve that investors wanted to hear today.
That actually is a lot of new information that we found out from the Federal Reserve Chair. Sarah, you were in the room as Jerome Powell discussed bolstering bank supervision and then took a quick Q&A. Let's quickly show our viewers a clip of that and get your reaction on the other end.
We're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? It's clear that we do need to strengthen supervision and regulation. And I assume that, there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
So, Sarah, tell us more about what Powell said about these recent bank failures and the Fed's decision to raise interest rates in spite of them.
Yeah, so, I think Powell was really trying to project some confidence going into this. It's the first time we heard from him publicly since the failure of Silicon Valley Bank and Signature Bank. And of course, the Fed played a key role in the response to those bank failures. And he really echoed some of the remarks we've heard from Biden administration officials, where he said that the banking system remains safe, it remains sound. He called it resilient. But, he did talk about the need for review. I think it's interesting he would not weigh in, despite being pressed multiple times, on what exactly went wrong and how they need to address it. He really just pointed to that review that'll be done by the vice chair of supervision. When he gets into that, as he stated there, you heard him say that he will support those recommendations. But he wouldn't speculate. He said it was inappropriate at this time. But it is interesting because he did also note that with everything happening right now, just 2 weeks ago, he was talking about perhaps a 0.5 percentage point hike at today's meeting. Then we saw those bank failures and the turmoil in the banking system. So 0.25 percentage point hike today. But he did say they did actually consider even pausing rates. But at the end of this, he did point out that he believes that inflation remains too strong. Of course, the labor market remains tight. And so that was what gave him the incentive to do this 0.25 percentage point hike. And he did also mention that he believes that the actual turmoil in the banking system, what happened, could have its own impact on inflation. And so perhaps rather than an interest rate hike, that itself could have an impact there. So it'll be interesting to see where this goes moving forward. But like you said, not expecting to cut rates this year. And that's really what the takeaway.
Yeah. And on that, JD, I want you to join back into this conversation because The Fed is trying to cool inflation. That's their #1 priority. And in many cases, part of doing that means pushing the economy really to the breaking point, but hoping it doesn't break. And then some people started talking as Errol was out there standing in front of Silicon Valley Bank that was failing, that maybe this was one of the breaking points, one of those indicators. Since it's not, based off of what we have seen, what are really those benchmarks that he's looking for? And is it really just about bringing that inflation number down, or might there be other things that the Fed and that Jay Powell in particular is continuing to watch with a great deal of interest?
Well, given that the central bank here in the United States has a dual mandate, first to maximize employment, the second to stabilize prices, I would argue, yes, it's that inflation number that's really important. My apologies in advance for the wonky phrase I'm about to use here, but core PCE ex housing. I know that means little to nothing for most of your viewers, but that's the phrase we hear over and over again from Chairman Powell. It's essentially a measure of inflation in the services sector, a part of the economy specifically, stripping away the most volatile elements of food and energy, as well as stripping away something like shelter and housing, which can be impacted with extreme swings in weather. So, yes, I think that particular inflation gauge, Chairman Powell has been incredibly consistent going back to March of last year to say those numbers are still a bit too entrenched. They're still too stubborn. Part of our goal of price stability to get inflation back down to a goal of 2% is going to be continue to raise interest rates. But we've seen goods inflation begin to tick in the right direction as well. The labor market remains tight. Wages remain very high. And we also follow that unemployment figure. The last jobs report indicated it did go up a bit from 3.4, a historic low, up to 3.6. But the Fed's ultimate guidance actually indicates unemployment will likely go, in the opinion of Fed officials, as high as 4.6%. You might remember that was a part of the kind of chippy or contentious back and forth a few weeks ago between Chairman Powell and Massachusetts Senator Elizabeth Warren. So I would certainly argue it's that service sector inflation metric, but there are certainly a lot of other things that the Fed is focused on. After all, Chairman Powell likes to say, he's very fond of saying we are data dependent. I think that's a bit of an indication of a lot of the data points the Fed has to take into consideration as we continue on into 2023.
Yeah, well, JD, no need to apologize. We discuss core PCEX numbers all the time.
It's like our favorite topic.
You know, we chat about this and giggle about this all day. No, I certainly do appreciate that. Sarah, in our last few moments then, considering we've got a lot of info from Powell about the expectation for interest rate hikes, but when might we see then inflation cool, or at least for our viewers, when they see the costs of everything not jump so high?
You know, I think it's interesting. Powell did say that he has started to see some moderation in inflation. But like JD said, there's really still an issue with the service sector. So goods coming down, the service sector is still a bit entrenched. And that is what's keeping them raising interest rates, at least at today's meeting, and potentially moving forward. They really didn't want to weigh in on the rate hike we could see in May. Of course, like you said, coming in with the data. So he'll keep an eye on that. But, you know, I think it is interesting to say they do put out projections when they have this meeting today. And originally in December, they had that PCE number would be 3.1% in 2023. They actually revised that upwards to 3.3% according to their median projection. So that's a little bit higher than we actually were anticipating in December. But of course, other measurements as a part of what they project did come down slightly. So it'll be interesting to see kind of where they go. I think it's really interesting. He was asked specifically about those rate cuts or potential interest rate hikes moving forward, and he really didn't want to weigh in on the specifics. But he said in his opening remarks, and then again during the question and answer, that some additional policy firming may be appropriate, which is different from the, yes, we're definitely raising interest rates in the future, as kind of what we expected when he had his last meeting. But he said we should really focus in on the words some and may moving forward. So I guess we'll find out in May kind of what that means. But we've got a lot of data to look at before that.
Everyone loves the grey area. Sarah Ewall-Wice, thank you so much. JD Durkin, thank you. And for your compliment earlier. I certainly appreciate it. We'll have you both back very soon.